Well, thank you very much, Rodney, for that really insightful look into the local and the global economy. And thank you to all of you for coming as well, with a lot of familiar faces and then a lot of new faces as well, taking time out of your busy schedules to hear a little bit more about exchange-traded funds. And as we heard, Brexit, the US elections in November, we've got the French elections coming up in March of next year. The resurgence of the political economy has never been more important to manage market risk and then also asset class risk, and we're seeing ETFs being increasingly used to do that. And so in order for ETFs to be used in client portfolios, advisors need to be comfortable with three things. Firstly, you need to believe that the ETF is going to deliver the market risk that you're looking for. Secondly, with over 130 on the ASX alone, for those of you who find it easy to execute on offshore exchanges, there's over 6,000 worldwide. How do you select which ones to use? And we'll have a look at a due diligence process, some of the important things. Thirdly, when you go to pick up the phone to have the conversation with your client about that selected exposure, what sort of things are you looking to say? And the packs that you've got in front of us today, we've built those with that in mind. So we haven't just provided information for you as advisors and brokers, but then also information that will help educate your clients as well. So Rodney talked a lot about risk. I'll carry that thematic through for the next 25 minutes or so as we implement the benefits of diversification into some practical examples, portfolios. And I'll start off with the foundation of capitalism, which is the theory of creative destruction. Joseph Schumpeter, an economist in 1942, argued that when you introduce new processes, technology, products into a market, existing processes, products and technology become obsolete. And so when we introduced the $1 and $2 coin, we had to say goodbye to the $1 and $2 note. And as we start to use tap and go technology over the next sort of 5 years or so, we'll start to see less and less of real money itself. ETFs are newer technology, there's no doubt about that, but we very rarely see them being used in isolation. We always see them being used in conjunction with other investment vehicles. So whether it's direct stocks or managed funds, where we are seeing innovation is within the advice model itself. And so the traditional investment advisor that was focused on outperformance, on picking winners, on market timing, which, as you know, even with a large research team is very difficult to do year on year, we're seeing that moving over for the strategic advisor. So a focus on asset allocation, on portfolio construction, and most importantly, guiding behavioural coaching clients towards their long-term investment objectives. And we're seeing ETFs being used more and more within that strategic advice model. And that's whether it's here in Sydney or across Australia, the Asia-Pac region, across Europe and the US. That's something that's driving exchange-traded funds growth globally. So if you feel that ETFs have a place in client portfolios, what sort of things should we look at when we're selecting a particular exposure? And the first thing we should be looking at is the provider. So is the provider an entity that's experienced with dealing with the ETF ecosystem? And by that I mean with index providers, with global exchanges around the world, and then also with market regulators, not just ASIC, but the SEC. Second thing we look at is what's their support model? So do they have local business development managers that can get you answers to your questions quickly and accurately, or is their service model simply via a website? Second thing we need to look at is the structure of that exchange-traded fund. You may find it interesting to note that 90% of global ETF assets under management are physically backed, fully replicated ETFs over stocks and bonds. And so with that comes the benefits of that product category that has made it so popular: cost-effective, diversified, transparent, liquid, tax-effective exposure. In contrast to that, leveraged and inverse ETFs, whilst they get a lot of press, only make up about 1.5% of global assets under management. So leveraged and inverse ETFs, at Vanguard we don't construct them. And the reason for that is that in some market conditions, they simply don't work. The third thing we need to look at is liquidity. There's two sources of liquidity within an exchange-traded fund. The first source is on the exchange itself, so the trading of the ETF on exchange, and the second source is the liquidity of the underlying constituents that that ETF is tracking. Sorry, the liquidity of the underlying constituents that's using the benchmark that that ETF is tracking. And so we need to look at two sources, firstly on exchange, but then also the liquidity of the underlying constituents of the index. So three things to look at, and some pointed questions there to ask of your ETF provider. Rodney spoke a lot about costs and showed the power of keeping costs low over an extended period of time. And what we've got here is just a really simple framework for you to compare certain ETFs. And we've got two costs within this. Firstly is the MER, so the management expense ratio, and the second is also the buy-sell spread. When you're looking at a spread, look at that in the context of getting that type of exposure by some other investment vehicle. So you might be looking at a managed fund, and you can see that 11.5 basis points or 10 basis points starts to look pretty competitive. VGS, which is Global Developed Market Exposure, and I've compared that to a competitor ETF which is sold as a proxy for Global Developed Markets. VGS is putting a wrapper around 1,500 stocks across 20 global developed markets, and so when you're looking at a spread of 11.5 basis points, that would be a lot more cost effective than buying those underlying constituents, and the ETF starts to look pretty competitive. The last thing that I'll say on costs is that keep in mind your client's investment horizon, because if you're choosing an 18 basis point MER relative to a 40 basis point MER, that 22 basis point saving for what might be very similar exposures is something that's going to add up over time. So a really simple way to analyse costs, and we produce that data every week, and we're more than happy to share that with you. So moving from due diligence over to solution mode, what we see out in the market, three pretty common uses for exchange-traded funds, and we'll build out some thematic exposures, we'll construct some asset classes, and then we'll look at holistic portfolio construction using exchange-traded funds. So firstly, taking a look at thematic ETF trading, as we go around the world in three trades, a really popular trade in the Australian market over the last 2 years has been to trade into US equities. So I'm bullish US equities and I'm bearish the Aussie dollar versus the US dollar, and VTS has been a really good way to play that. VTS contains over 3,600 individual US listed securities. The ETF is putting a wrapper around that and allowing you to trade that with the convenience of ASX execution. It covers 99.5% of the US equity market. The S&P 500 only covers about 80%. And we've seen that trade go pretty well over the last 2 years. VEQ, trading into broad market developed Europe, getting access to economies such as the UK, Germany, Switzerland and France, building out exposures that aren't readily available on the Australian Stock Exchange. And the last region we've got there is VAE. So that's 10 countries across regional Asia, giving you access to companies like China Mobile, Samsung and Taiwan Semiconductors, building out GIC sectors and exposures that are, again, poorly represented on the Australian market. So trading into the US, Europe, Asia in isolation is something that we see as a really common use for exchange-traded funds. Alternatively, you can use those three trades to build out your international equity exposure. And so you can take a view that there may be some growth opportunities in the US relative to Europe. I'm a little bit worried about the volatility over there, so I'll overweight the US equity market. VAE, the Asian region, a lot of emerging market economies in there. Have they been oversold over the last 2 years, and are there some growth opportunities, and so you might want to dial up that exposure. You can use them with flexibility and control, something that's driving ETF usage across the planet, to suit your particular view, and here is where we're starting to see what is essentially a passive investment tool being used in a very active way. So I'll move from thematic portfolio construction over to asset class solutions, and this is the first of 2 case studies today. I'd like you to meet John and Eleanor, John and Eleanor, mid-50s, two-income family. Current portfolio is composed of Australian equities and cash, and the research that we're getting suggests there's a lot of portfolios out there that has that kind of concentration risk. Anne spoke about that. They're aiming to maximise their savings pre-retirement, and they're looking for professional investment advice. And more often than not, we see the solution start with the implementation of an international equity portfolio. So what we're going to use is global developed markets and global emerging markets. Now, quite often we see clients just using VGS, so 20 global developed markets, and that's the core component of that asset class. But we think that there's pretty good, there's room in a international equity portfolio for emerging markets as well. So if the client had $100,000 and they put $90,000 into VGS and $10,000 into VGE, they'd get a very strong correlation to a popular international equity benchmark. So any active fund manager that's picking all the best stocks around the world will more often than not benchmark themselves to MSCI ACWI, and now you can build that with 2 ETF trades. The performance of MSCI ACWI over the last 10 years, as we've come into the global financial crisis, muted currency returns from the commodity boom, around about the end of 2013, we were asked to come out and present on international equities in pretty much every presentation we were asked to give. And the reason for that was that it was up 25%. So if you put international equities into a highly concentrated Australian equity portfolio, because of performance, if it doesn't go that well next year, in terms of what it's done historically, that could cause a difficult conversation with the client. What's really important, I think, to cover off in the conversation is that whilst performance is very important, it only tells half the story. And what I'm doing here is I'm starting off with an Australian large cap portfolio. So VLC is an ETF, a large cap ETF that we have on the ASX. And essentially it's the largest 30 stocks by market cap in Australian equities. And the reason I'm using that is because it probably broadly represents a lot of Australian equity portfolios that we see. The volatility of that portfolio coming in at 14.5% is broadly representative of the Australian market. And when we add in the international equity portfolio, one of the major benefits of ETFs starts to come to the floor, and that's the benefits of diversification, because within those 2 trades, we're adding in over 5,500 individual securities across 40 developed and emerging market economies. And so what that does is it brings portfolio volatility down by about 24%, giving clients access to industries and companies and geek sectors that are poorly represented on the Australian market. And you're also giving yourselves the flexibility to swap out that unhedged exposure, swap in hedged exposure, exact same exposure in the form of VGAD if you want to, and give yourselves the flexibility and control to dial up or dial down the developed market exposure versus the emerging market exposure if you think that, well, emerging markets have underperformed developed markets by 14% for the last 2 years. Is there a buying opportunity, and do I want to overweight that? That's the flexibility and control that starts to come through. And a pretty good result, because if the client is having the same expectations of returns, your expectations of asset class returns going forward, and they're doing that with a lower volatility levels and a smoother ride, that means easier conversations for you during times of severe market dislocation. So let's move on 5 years. I've used the same photo, but you'll have to believe me when I say they're in their early 60s now. One income, current portfolios composed of Australian equities, international equities, we've added that, and then also cash. And they're looking for professional advice on international fixed income. So I'm going to build out this solution in exactly the same framework as I did international equities. We're using 2 ETFs, international fixed interest in VIF. Quite often we see that just being used as the core component of international fixed income, but we think that there's room for credit securities, international credit securities in portfolios too. So if the client had $100,000 and $65,000 goes into VIF and then $35,000 goes into VCF, they get a strong correlation to a popular international fixed income benchmark, which is Barclays Global Ag. 10-year performance from 2006 to 2016, and this is where it's more important than ever to heed the information that Rodney gave us on expectations of asset class returns going forward, not relative to what we've seen in the past 30 years. But let's have a look at this from a risk and return perspective. I'm just going to recap where we started from. 30 of the largest stocks on the ASX, that was our original portfolio. We added in international equities, and now we're adding in international fixed income. And I'm sorry if I've thrown a lot of acronyms at you in the last 15 minutes. This is the last one. We're also going to build out a 30% exposure to income assets with domestic fixed income exposure. Okay? So international fixed income, domestic, and this starts to look like a risk profile of a growth portfolio where you've got 30% of the assets in income and you've got 70% of the assets in growth. The analysis of the risk and return profile, where we started 30 of the largest stocks, 14, we brought that down 25%. Now adding in fixed income, we're lowering the level of volatility within the portfolio by 50%. In 5 trades, we've added in over 10,000 stocks and bonds across more than 40 developed and emerging market economies. And here's the power of exchange-traded funds. You've got the flexibility and control to do that. And I won't lend too much time to the increase in performance that the client would have got, because it's easy for me to build good portfolio returns in hindsight. But regardless of what happens going forward, in your views on asset classes and portfolio construction, that volatility levels are much easier to predict than asset class returns, and that lower volatility will flow through. Again, easier conversations with your clients during times of severe market dislocation. The last case study for today, Sam, early 40s, 280K in super, invested in stocks and cash, wants low-cost investment, seeking advice on a range of asset classes. So it's an interesting challenge for Sam, because whilst $280,000 is a significant amount of money, is it enough for Sam to be a profitable client within your business? And so we start to need to entertain scalable solutions that are going to provide good outcomes for Sam, but then also capture that next wave of clients looking for advice. So I'm going to talk quickly about our diversified managed funds, and the economic analysis that Rodney went through is powered by a proprietary simulation engine called the Vanguard Capital Markets Model. That model produces our outlook and commentary that we take out to market, but it also incorporates a model that comes up with the strategic asset allocation or asset class weightings within our diversified funds, managed funds that we offer out to the market. And the performance has been fantastic. Implementing strategic asset allocation with a very sophisticated research team, low-cost investment vehicles in terms of implementation, and the performance over each time period and across the 4 growth profiles has been significant. Saw a Morningstar report yesterday where half of those dots are actually top 5th percentile. And the reason why I'm talking about diversified managed funds is because you can build those with ETFs too. So since we listed international fixed income, you can build out each of those asset classes, and what a great solution for Sam. Here we've got the income assets, the growth assets, a very sophisticated model portfolio, and implementation by simple ASX execution with 7 trades. And Sam's getting access to over 11,500 stocks and bonds in those trades. And if you think back to early 2000s, when this notion of diversification used to be, say, 20 stocks across 10 different GIG sectors, the technology is now available to you on the ASX to build something significantly different. What I would encourage you and your clients is to not mistake simplicity with lack of sophistication. There's a huge amount going into the asset classes, and then also the delivery of these low-cost investment vehicles. And Sam's getting that result for 13 basis points. So Rodney ran a simulation on Dan, $170,000 more by keeping the costs from 110 basis points down to 50. Well, if your clients are currently investing at 110 basis points and you can bring it down to 13 on $1 million portfolio, over 10 years. It's a pretty significant improvement. That's a concept that we call advisors alpha, keeping costs low, keeping more money in the portfolios over a long period of time. That's the high growth portfolio. We've also got the other risk profiles, and those risk profiles and some commentary around that are in the packs that you've got. So what does it mean? Well, as fund managers, we're obsessed with the efficient frontier, and you're moving clients closer to the efficient frontier where they're getting an appropriate amount of return for the minimum amount of risk. Simple yet sophisticated, and also genuine diversification. What does it mean for you? There's less time picking winners, market timing, moving over towards that strategic investment advice where you're focusing on asset allocation, portfolio construction, wealth management, and also customised risk and return analysis. So what do I mean by that? We all get the modern portfolio theory, but sometimes what's difficult for advisors and brokers is that how do you customise that for a client, especially a self-managed super fund client, where they're their own investment managers. They always think they're doing a good job, but how can you say, well, actually, you are taking on more risk than the broader market, and the returns haven't been as good? Now, I wouldn't pose the question if I didn't think I had a solution. What has worked very well in the US, and we're seeing a large take-up of this resource down in Australia, is it's a portfolio modelling tool. It's powered by Morningstar data and allows you to take your client's portfolio, whether it's an existing client or a prospective client, load it up into this engine, look at the risk and return profile of the existing portfolio, and then compare it to the investments that you'd like to layer in. It doesn't have to be Vanguard ETFs, it can be any managed fund, direct stock or ETF on the Australian market. And so the output is 7 pages of analysis that you can choose to show your clients as much or as little as you want, depending on their level of sophistication or the level of education that they have. The output is from you. It's not branded Vanguard, it's from you to the advisor, and we're seeing that that customised analysis can really help complement your already robust advice processes. And I'd encourage you to log on to the internet and reach out to us for a training session. So just in finishing, we've got 17 ETFs on the ASX across the asset classes, fixed income, property, Australian shares, and international equities. That has been a theme for today, and we're giving you the flexibility and control to dial up and dial down exposures. If you want broad market, regional exposure, low cost, hedged, unhedged, if you want to develop versus emerging, and also low administration. The research that we're doing is telling us that clients and you don't like filling out W8 Ben forms. The vast majority of our international equity ETF product set, you don't need to do that. So with that, I'll finish by saying that adopting ETFs within portfolios or looking for new ones to use or changing particular exposures, there's a decision tree there and it's a journey. And we have the largest ETF, BDM and BDC support team in Australia. Many of them are in the room here today, and I'd encourage you to reach out to us because we'd love the opportunity to go on that journey with you. So with that, I'll thank you very much for your time and I'll hand over to Anne.